Hey, good afternoon. Welcome, everybody. I see a number of attendees joining. We're excited to have you here with us. We'll get started here in just a couple minutes. For now, grab a nice drink and get comfy and settled in. Hopefully, you have your pen and pad ready to go and take a bunch of notes here. We're going to jam a lot of information here in the next hour or so. Again, we're right at the top of the hour. We'll get started here very shortly. I see a few more people getting in. Great to have everybody. We're excited to share knowledge and wisdom with you here this afternoon and or morning, depending on where you're joining from. Dan, great to see you. Welcome. Sarah, you as well. Welcome. Great to have you. We're excited to get started. We're going to give another minute or so for everybody to get settled and join us. We've got a lot to go over again, as I mentioned, and we want everybody to hear that registered and is able to attend. Okay. Well, welcome everybody. Again, it's the top of the hour. I don't want to waste a lot of time and make sure we have plenty of time to talk about all the information we're going to present here today. As I mentioned earlier, hopefully you're settled in, you're in a comfy chair. You've tuned out all the distractions. We're going to give you so much information today to think about that we want you to be in a good position to hear it and then ultimately have your pen and pad ready to write any notes. There will be an opportunity at the end of this. If you don't take enough notes or want more information, we'll talk about what that looks like. But today we're here to talk about protecting and growing your assets for a worry-free retirement. And before we jump in, I want to introduce myself. My name is Conrad Levesque. I'm a certified financial planner, which is the gold standard in the financial services industry. I'm also a CPA, and I'm a bucket plan certified consultant. I'm a senior wealth and tax advisor here at Alison Wealth Management, and I've been in the industry for longer than I necessarily want to admit. You can tell by the gray hair. I have plenty of time and service, well over 20 years at this point. I am joined here today with my colleague, Dave Allison. Dave, welcome. It's great to have you.
Yeah. Thanks, Conrad. It's great to be here.
Yeah, awesome. Dave is also a certified financial planner. He's an enrolled agent admitted to practice before the IRS. He is also bucket plan certified. He's the CEO and founder of Alison Wealth Management, among other things. But we could go on and on about Dave's certification and accolades, but I think would probably take up the next 30 minutes, unfortunately. So we're going to skip a lot of those today. Dave, great to have you again. I'm excited to share all this information. Before we jump in, is there anything you want to share with all our attendees?
No, I want to welcome everybody and just remind everybody this will be interactive. So if you have any questions, please feel free to throw them in the chat. Conrad and I will try to get through them. If we don't, by the end of today's meeting, we can follow up via email. We're also going to offer a strategy session, an introductory call with anybody that attended this. And so there is an offer. If you look in your right-hand side of your screen, you should see a link where you can access Conrad's calendar directly. So just a little bit of housekeeping. But again, any interactions, questions that you might have, hopefully we should be able to get to answer them in today's webinar. In addition to that, you're going to see Conrad and I are going to make this interactive. Conrad joked about the gray hair. I think him and I both have. And honestly, it's not just from the kids that we're having. It's, of course, from some of the big mistakes that we've seen people make over the years. And I think, as everybody who's attending this webinar today knows, as you approach retirement, quite frankly, there's just less time to make mistakes, and there's a lot of uncertainty going on right now. So let's talk a little bit about why we're here. I mean, we're here because we're facing a historic event. That event affects 78 million Americans. It's never been seen before anywhere on earth, and no one is completely sure of how to deal with it. And this event that we're talking about is retirement, right? Have been and will be over 78 million baby boomers that are retiring. And we're in some really interesting times for individuals that are retiring. We've got the stock market continuing to make new all-time highs. We have interest rates that are at an elevated level. And we're going to talk about some of the things that we feel people approaching or already in retirement should really be thinking about. We're going to talk about 3 major financial dangers that will impact the quality of your life in retirement. We're going to talk about how we feel like right now in today's environment, we're in this perfect storm. Like I said earlier, market continues to hit new all-time highs. Interest rates are high. And like many others, we feel they're probably going to be coming down over the next 6 months, year, 18 months. And all of that really forms this perfect storm of an impact on somebody in retirement, in that distribution phase of the money cycle. And so that's what we're going to talk about today. We're not going to just talk about the scary stuff. We're going to talk about some of the strategies, solutions, ideas that we've been implementing with clients and would be happy to share with you further based on your individual situation. And so, Conrad, I know when we were mapping this out, some of the goals that we talked about tonight was we wanted to just give a high-level explanation of some of the risks. We want to show everybody who attended this webinar some ways they can overcome or at least mitigate those risks. We want to share some specific strategies that our viewers can use right now that other clients of ours at Alison Wealth Management have been using. Of course, we're going to answer questions and hopefully have a little fun along the way. Who would have thought talking about taxes and investments and retirement income could be fun, but we'll try to make it fun as we go through the course curriculum. Sound fair enough, Conrad?
Listen, I'm excited. I'm ready to jump right in.
Awesome. Well, let's talk a little bit about Alison Wealth. This will be my quick 30-second commercial. What we do at Alison Wealth, the team, Conrad, myself, David, Brittany, the resources that we have, we focus on simplifying complex decisions and delivering holistic strategies that give you the freedom to focus on what matters most. We call this our 5 pillars of holistic wealth management, helping our clients with financial planning. But we go beyond just financial planning into asset management, tax management, protection planning, and legacy planning, because we feel all of these things need to be coordinated and in harmony like an orchestra. I mean, Conrad, you mentioned you've been a CPA for over 20 years. Yeah. How many times did you see that as your client's trusted CPA, you were not coordinating with their investment team or their financial planning team, and you'd see a mistake on the tax return that could have been avoided that ended up costing the client an incredible amount of unnecessary or avoidable taxes?
Yeah, I think it's easier to answer that question with the opposite, right? The number of times that I saw it successfully deployed in over 20 years, which is one time. Think about that. Hundreds of client situations a year, only one ever came to me and said, hey, we should coordinate all of these things together, right? And so that's a massive hole. And really the reason why I decided to pursue the CFP education and provide holistic wealth management.
So let's talk about the bucket plan. Most people who are watching this webinar have received a complimentary copy of the bucket plan book. It's been a bestseller, top 10 retirement planning books for 2023 by US News and World Report. If you haven't got a copy of this, go to Alison Wealth's website. Under resources, you could request a copy. We'll ship it out to you. But the bucket plan is our holistic wealth management process that we take every new client through. It coordinates all aspects of your finances, ensuring that your investments, tax strategies, insurance policies, and estate plan align seamlessly with your goals. At the end of the day, money's just about achieving your goals and objectives, and the bucket plan helps us make sure all those things are aligned. Yeah. And so let's jump into the 3 retirement dangers that I mentioned at the opening of this webinar. The first 2 are things you've probably heard about before: market risk and interest rate risk. The third one, sequence of returns risk, might be something that's brand new to you, but we're going to talk about the impact that these 3 dangers have on somebody's retirement. We're going to go through these things one at a time. And again, if you have any questions at all, don't hesitate to type them into the chat box. So Conrad, let's talk about market risk is the first one.
Sure.
Now, market risk is the fact that we all know that the stock market in some cases can seem like a bit of a roller coaster ride. There's a lot of uncertainty, right? There's the potential for loss, there's increased volatility, and what we do know is we are at a historically high level of the stock market. Right. We all know the stock market goes up and down just like a roller coaster. And compared to the past, it seems like today's ride is a lot scarier. We're seeing a lot more volatility in the market. There's a lot more computerized trading, algorithms, high frequency trading, right? The machines are running a lot of the trading in the stock market, and that creates a lot more volatility and uncertainty. Right. And see, what's interesting is people approach retirement, specifically retirees today, the baby boomer generation that's heading into retirement, is they might say, well, Dave, who cares? Stock market hasn't been a problem. The volatility hasn't been a problem. I mean, let's look at the last 20 years. Long-term growth has been great. I mean, if you invested $500,000 20 years ago in the S&P 500 index, that 500,000 would have grown to over $3.75 million today, right? We've seen outstanding growth. And this is in light of the great financial crisis in 2008 and 2009, the pandemic in 2020. We saw a pullback in 2022, right? There's been an enormous amount of volatility, but long-term growth has been great. The thing to consider as a retiree or somebody approaching retirement is, where are we now? And are these record all-time highs going to continue as we close out 2024 and go into 2025? I mean, this visual chart shows you, and it's really hard to even see the scale and the magnitude of these pullbacks because the growth of the United States stock market has been so high. But the reality of it is, market volatility is likely to continue. The current bull market has experienced historical gains in growth. And I think most people would agree, even if you're an optimist about the long-term, growth potential of the stock market, I think most people would agree the risk is high for a down cycle. Yeah. And when we talk about the market, it's really what we call soon money that's in danger, right? If you've got a long time horizon, another 5, 10, 15 years before you're going to need to tap into that money, you're probably all right. Near-term market risk isn't really going to cause a lot of chaos in your retirement plan. But for retirees that may need or will need to access a portion of this money to live off of, this is where really the danger zone comes into play. And this is what we need to take into account and what we'll talk about regarding some solutions for the bucket plan.
Sure.
Now, the next danger is interest rate risk. And so we all know right now interest rates are at a recent high. We went through, the most historic Federal Reserve hiking of interest rates that we've seen in quite some time. And we saw the negative impacts of interest rate increases over the last few years. For example, as interest rates rise, the value of bonds fall. And we saw a lot of retirees take big losses on their bonds, not our clients for the most part, but just across the industry in general. But now that interest rates are high, if and when the Federal Reserve does start to cut interest rates and continues to cut them like they've been doing the last few months, there's some additional adverse effects that we need to think about. The nice thing is, if you're in bonds, hopefully the principal value of that bond will appreciate as interest rates fall, but it does impact bond funds and the interest that a retiree might be living off of from their bond funds. It impacts their fixed income investments, cash, money market, municipal bonds, and it impacts annuity payouts. You see a lot of retirees as they go through this accumulation phase and they start to enter the distribution phase, they like some guarantees around their income. And one of the few places that you could actually guarantee income is at an insurance company through an annuity. In fact, this was a really great article that just came out by the Protected Lifetime Income Alliance. This was a group of academics led by David Blanchett and Michael Fink, who are kind of renowned in the retirement research space. This came out a couple months ago, but they put this headline that retirees with assets that annuitize income spend twice as much as those with non-annuitized income. They call this the license to spend. And I know, Conrad, we've had this conversation with some of our clients that they're afraid to spend their retirement savings because they live what I call a what if retirement.
Right.
Well, what if the market falls? Or what if I live till I'm 90 or 100? Or what if I have a large healthcare event? And they're afraid to actually consume a larger portion of their assets today when they could actually enjoy it and they have the health and the ability to do fun things. And an annuity could be a fit in your retirement plan with this kind of idea that you're creating and giving yourself a license to spend. Absolutely. If you have a portion of your money annuitized to generate lifetime guaranteed income.
Yeah, this is such an important concept here, especially as we're talking about approaching retirement and what you want to spend in retirement. You said, and this article says, hey, retirees spend twice as much. That not a percentage greater, twice as much. That's such a huge impact that it could have on somebody's life. And for all the negative things that we see about annuities, then this is the study that comes out. And I think it goes to show, if you're not thinking holistically about your plan, you're going to likely miss the ball here.
Well, and what's interesting about this, I just had this conversation recently with two clients, is they said, look, the stock market's been a great driver of growth for our assets, for our retirement, but they were having some concerns that we might see a pullback in the market, and they wanted to be able to structure a piece of the portfolio to just go spend. And so in a couple cases, we'd peel out a bit of the gain, shift it over to an annuity, provide a guaranteed lifetime income payout, and give them the peace of mind that they can spend. And if we look at where interest rates are, this is just a quick graphic of the Fed funds rate, because I want to talk about the opportunity that if you had ever considered an annuity at all as a piece of your retirement plan from a diversification standpoint, now is probably the best time to ever look at them, because we know interest rates are higher right now. And when interest rates are higher, the guaranteed payout rates of annuities are higher. And if we think interest rates are going to continue to decline, that means the payout rates of annuities are going to decline. So when's the best time to buy an annuity? Well, it's when your market values are at an all-time high, because we're locking in some of those gains. And it's when interest rates are at an all-time high, because we're locking in the high lifetime payouts. And so when we look at the impact of interest rate cuts for retirees and how we're thinking of actively managing portfolio assets, number one, if a client is living off of some of the yield from their portfolio, then lower yields from portfolio assets are going to result in a decline of income. That means we might need to go sell more assets or sell more shares to generate the same reliable income that that client needs. We'll talk about sequence of returns risk in a little bit. But the impact of interest rate cuts also means a future decrease in annuity payout rates for lifetime income. It means a decrease in fixed income interest. It could mean a decrease in bond rates. All of these things are lower income streams or cash flow to a retiree client. And we're going to have to come up with the deficit of what they're accustomed to by potentially having to sell assets. Right. And that's what leads me to our third retirement danger, which is a concept called sequence of returns risk. And this may be the most dangerous one of them all. And you see, we all go through what we call the money cycle. And there's, this accumulation phase when you're working, you're saving money for retirement, you're building your nest egg for the future. And then one day you're lucky enough to retire and you go into what we call the distribution phase. You're retired and now you're drawing income from your portfolio to live on to supplement Social Security and maybe even a pension. And we're not going to talk about Social Security in this workshop today. We do an incredible amount of Social Security optimization. We've got some great analytical software that not only takes into account the ideas of deferring or taking it early, but we look at the taxation of Social Security and how that might be parlayed in other tax mitigation strategies. But again, if Social Security is of interest to you, just shoot us a message with Social Security in it and we can talk a little bit about that. But I want to get back to this idea of sequence of returns risk. And I want to show you this very simple example. Let's imagine you have $1 million in your investment account and you're in the accumulation phase of the money cycle. And you give that $1 million to us and we invest it and we earn an average of a 6% return over a 10-year time period. And you're not taking any withdrawals at all out of the account. And as we all know in the market, if we average 6%, it doesn't mean we get 6% every single year. It means that some years we're going to have really good years. Some years we're probably going to have really bad years, and they ultimately end up averaging out. So here's an example of that. We have, let's say, 2 great years early on, positive 30% and positive 20%. And then in the middle, we have 6 years of a 10% consistent return. And then at the end, we have 2 bad years, negative 20 and negative 30. So what you'll notice here, simple math, if the positive 30 and the negative 30 cancel out, the positive 20 and the negative 20 cancel out, that leaves us with 6 years of 10. 6 times 10 is what, Conrad? I know you're a CPA.
60.
60, right? And 60 divided by the 10 years gets us to what?
6% average rate of return.
6% average rate of return. Now, this is the lifestyle that we're all kind of accustomed to when it comes to investing, right? We're socking money away. We're saving as much as we can. And under this sequencing of returns, you could see that at the end of 10 years, your $1 million has grown to $1,547,000.
Woohoo!
Now, what happens if we reverse the order of the returns? So in this scenario, we have negative 30 in the first year, negative 20 in the second year. At the end, we have the positive returns. So all we did was we flip-flopped the order of the returns. And what you can see here is at the end of the 10 years, we have exactly the same account balance, $1,547,000. And so what this tells us is that sequence of returns risk does not matter during the accumulation phase, which if you've spent most of your investing life in the accumulation phase, there's a good chance you might not have ever even heard of sequence of returns risk. If you're working with a current advisor and they haven't shared this with you, it might be because they're more of an accumulation specialist instead of a distribution specialist, because once you start entering the distribution phase, you need a whole different strategy to manage this. And I'll give you an example. Let's say that we go to the distribution phase now and we have the same $1 million. We're going to average the same 6% return. So 6% on $1 million is 60,000. I mean, conventional wisdom would tell me that if I have $1 million and I'm going to average 6% over time, well, I should be able to take out that 6% or 60 grand a year and use that to supplement my retirement. Well, in this scenario, I highlighted in red here, the $60,000 distribution. Here we have this scenario with 2 great returns early on, 2 bad returns at the end. So the same 6% average return over time. And you could see at the end of 10 years, we started with $1 million. We took out $600,000 over 10 years in withdrawals to supplement our retirement. And we still have almost $1.1 million left over. Pretty good outcome, right, Conrad?
Absolutely. I mean, and this seems so simple, right? You just start with the positive returns and with the negative. We should all be able to do that, right, Dave?
Well, there's no certainty on when we're going to get the good returns and when we're going to get the bad returns. I mean, here's the same example. In this case now, we start with the bad returns early on, -30, -20. We have the same good returns at the end. We have the same exact 6% average over that time frame, but is our ending balance higher, lower, or the same like it was when we were in the accumulation phase?
Yeah, that's a big difference. It's hard to ignore, right?
Well, this is what causes retirees to run out of money. I mean, I remember when I was advising clients through the great financial crisis in 2008 and 9, and there were so many stories on the news of people that worked 20, 30 years. In 2006, 2007, they had amassed their life savings. They thought they had enough money to retire. They thought if they can just average 5 or 6%, they can take out 5 or 6% for the next 30 years, and they'd be on easy street. Well, the reality of it is what happened in 2008 and 9. They had all their money invested like they were in the accumulation phase, but in reality, they were in the distribution phase. We saw some big market downturns early on in retirement, and it caused them to have to rethink everything. Right. Here's an example. I mean, again, almost 1.1 million versus 388,000 for the same average performance. This is why, Conrad, I know you and I always get a chuckle out of when people approach us and they say, well, my prior advisor has averaged the 7% returns or 10% returns or 12% returns, right? And that is well and good when you're in the accumulation phase. But when you get to distribution, the game changes. Losing money in the early years of retirement can hurt you. And I go back to what we spoke about earlier. Where are we right now? We're hitting new all-time highs. So you have to ask yourself, is there the potential that we could see a pullback sooner rather than later? And we call this the retirement red zone, right? When you're approaching retirement, we need to start to think about protecting the money that you may need sooner rather than later. I like to look at this about 5 years before retirement and then 5 years into retirement. This is that critical 10-year window that if you make a big decision that doesn't pay off, a bad decision that doesn't pay off, it can decimate your retirement. And we're not talking about all your money. This is just a portion of the money that you're going to need to rely upon. If you're a growth-oriented investor, if you're like me, I believe in stocks for the long run, that's all well and good. But we're talking about the money that you're going to need to rely upon for your income in the next few years. You see, we like to think about it as this preservation bucket in the middle. It's the period immediately before and after retirement when protecting the portion of your portfolio that you're going to need for income becomes really important. And that's why we established and built the bucket plan. You know, the bucket plan are just these 3 simple buckets of money we think everyone should have: a now bucket, a soon bucket, and a later bucket. Let's walk through these. So Conrad, tell me a little bit about the now bucket.
Yeah, the now bucket is really what you need in the next, 12 months from an income perspective. This could also include emergency fund or any planned expenses, but the funds in this bucket really are meant to be safe and liquid. These should be really in your cash or cash equivalents and should not experience market volatility because you know you're going to need them in the next 12 months.
Exactly. This is if I know I'm going to need, $5,000 to make my healthcare premium payment in 3 months, like there's no reason for me to invest that money. Keep it in a
Right.
money market, completely safe and liquid.
Absolutely.
Now, the soon bucket is really what most people miss. The soon bucket is invested for growth to help offset inflation. It's just invested more conservatively or more defensively or designed to provide you a reliable income stream through that first phase of retirement. We have some very growth oriented investors who they just want 2, 3, 4 years worth of income protected in the soon bucket. We have some more conservative investors who don't want to experience a bunch of risk or market volatility, who might want to structure more guaranteed lifetime income out of the soon bucket so that they know their retirement paycheck is taken care of. And then the stock market is really for the playchecks that are left, right? And you're willing to take on a little bit more risk. And last but not least is our later buckets. So Conrad, when we're building later buckets, what are some of the things we're thinking about here?
We're thinking about, I mean, it says right there, your long-term growth, right? We want investments in the later bucket to provide that long-term growth and be able to backfill the soon bucket as we see appropriate timeframes. But this is also thinking about legacy planning, and not legacy planning thinking about taking care of kids or grandkids first, but potentially your remaining spouse. This includes things like long-term care or disability. How are we going to fund those expenses as they come up, whether it be through cash or investments or through insurance? And this also includes an inheritance. Again, not just inheritance for your remaining spouse, kids or grandkids, but maybe you're charitably inclined and want to leave assets to a charity of your choice. And we want to think about those here in the later bucket.
Now, Conrad, what about taxes? When it comes to the later bucket, we deal with a lot of clients that are married entering into retirement. And unfortunately, the reality of it is both spouses don't pass away at the same time. Typically, one outlives the other. It's typically the female that outlives us male counterparts. They make smarter decisions and are healthier. But from a tax perspective, when we talk about legacy planning for the surviving spouse, give us the high level on what happens from a tax perspective.
Yeah, the high level is what we call the widow's penalty, right? Or widower's penalty. And in essence, what happens when you're married, you go from married filing joint taxes, and you enjoy higher tax rates or lower tax rates across higher bands, right? To going to a single filer, right? In essence, you are cutting your tax brackets in half, not all exactly, but in half, right? But you're not likely taking less income. You still have expenses of your home. You still have to pay for groceries and you're still traveling. So the likelihood is that your income remains closer to what it was before the passing of your spouse, but your tax rates have been cut in half. And so now we need to think about, from a legacy planning perspective, what the cost of higher taxes mean in the long run. Or in this bucket, like we do with many of our clients, how do we proactively avoid the impact of the widow's penalty on your overall portfolio?
And this is where things like Roth conversions or potential life insurance, that's permanent life insurance for a tax diversification play for the surviving spouse, can be really important. But, how many times do we have new potential clients coming into our office and we take a look at how they're structured right now, and they have what we call the not quite plan, right, Conrad? They've got a small pile of money in the bank, their emergency fund, their checking, savings, money market accounts. And then all the rest of their money is invested like they're still in the accumulation phase out in the later bucket. But in reality, retirement is right around the corner.
Yeah. Or what we've seen here recently, because interest rates on things like CDs or money market have been favorable, we see a large chunk of money in the now bucket, a majorly overfunded now bucket, right? Which is sacrificing growth in the later bucket.
Absolutely. Absolutely. So at the end of the day, we think the bucket plan is critical. David asked a great question. What's the duration of the soon bucket? And the answer is it depends. And what I mean by that is we have some clients that are just, I'll give you a quick story. One of the clients that we work with, he's been working with us for about 3 years. He's quite high net worth. He is incredibly sophisticated engineer, and he really understands investments and market and retirement planning. And so he actually has a quite large pension as well on top of Social Security. And what he wanted was only 2 years worth of additional funding in the soon bucket to essentially be like an emergency raft if there's a big market downturn, because he wanted all the rest of the money out in the later bucket in equity portfolios we were managing for him for long-term growth. He was okay knowing that if we saw a catastrophic market downturn and it took longer than 2 years to recover, he might have to make some not tough decisions, but he might have to pare back a couple things or just sell into the market at some losses. Now, we have other clients that they optimize the soon bucket and they want about 10 years worth of income in the soon bucket. You know, if you think statistically of a diversified portfolio in a big market downturn, from the top to the bottom to the full recovery, we've seen anywhere from about 3 to 5.5 years. Again, in 2008 and 9, we saw the markets top out, then they bottomed, and by the time they recovered, it was about a 4 to 5 year period on a diversified portfolio. So again, the purpose of the soon bucket for somebody who's more growth minded, you just want that kind of safety raft in there. So hopefully that answers your question. Now, for other clients, though, I could tell you, we worked on a plan with a client of ours who's worth $30 or $40 million. And we were able to put enough income producing assets in their soon bucket that it generates about $500,000 or $600,000 of net after tax income. And that's going to sustain pretty much their whole lifestyle. All the rest of the money is out in the later bucket, which is optimized for charitable giving and multi-generational wealth transfer plans, friends, families, things like that with the trust work that we're doing. So again, there's not a one size fits all solution. This is kind of a joke, a good slide to illustrate that. I mean, on the top left corner, this would be somebody who's got like more of a long-term focus on spouse, kids, charities. The now and the soon bucket are just enough to meet their income needs, and the rest of the assets are out in the later bucket. The bottom one is somebody who might want to spend more money early on in retirement. I talked to our clients about the 3 distinct phases of retirement: the go-go years, the slow-go years, and the no-go years. Well, I can't tell you how many clients come to Conrad and I, and they say, you know what, while I'm 65 to 75, I want a higher income stream because I want to travel the world and do all the things that I can do now that I might not have the health to do when I'm 75 or 80. And so that's a different design and strategy. Or some of my favorite clients, it's the party time clients. It's the ones who tell me, Dave, I want to spend everything I have, and the last check I write that's going to bury me into the ground bounces on them, right? They want to go and kind of have this die with zero approach. And so we can help optimize a plan and really kind of Monte Carlo out what the right guardrails are to be able to generate the highest amount of spending and consumption possible.
Yeah. I think, Dave, the big thing to remember, and David, to your question especially, is understanding what you want, right? Not us telling you should do this or that. It's ultimately designing a plan around what you want to have happen. And then we as professionals, design a plan around those types of items.
Exactly. But at the end of the day, if it's properly implemented, the bucket plan will mitigate market risk, interest rate risk, and sequence of returns risk. Yeah. It's behavioral investing 101. I always say it's where we are protecting a time horizon so that we could have the confidence to invest the rest. So that's just kind of simple, powerful explanation of the bucket plan, again, in our book, very detailed on the process that we take clients through. So now let's talk about what your single largest expense in retirement will most likely be. And Conrad, what are we thinking here?
It couldn't be housing or travel, could it?
Nah, I don't know.
Oh, man. I was going to say it's tax, right? It's got to be tax.
It is tax. And, if people feel like this is unfair, they spent their entire working career paying tax and now they go to retire and they have to pay tax on the withdrawals from their retirement accounts. They're going to be taxed on their Social Security. Taxes don't go away. But you see, Conrad's a CPA. I'm an enrolled agent admitted to practice before the IRS. We fully integrate taxes into all of our clients' retirement plans because at the end of the day, it's not about what you make, it's about what you keep. And there's 70,000+ pages of tax code. It all comes down to these 7 simple words. Not all money is taxed the same. And so what we want to do when we think about your bucket plan is how are we going to fill your buckets? And then how are we going to take your cash flow needs, your distributions from the buckets? And we really have 3 funnels. We have the pre-tax funnel. These are things like your pre-tax 401k, IRA, or pensions. You deferred tax when you elected to put money in here, but it's going to be fully taxed when you take the money out. You're going to be mandated to start taking the money out at a certain age, your required minimum distribution. And then when you pass away and you leave these accounts to your beneficiaries, the government, for the most part, is going to make your beneficiaries take all the money out within a 10-year time period, which ultimately means the government is going to be a big beneficiary of these accounts, particularly if you pass away with a large IRA. A lot of the work that we're doing right now, I just had a meeting this morning, a client with a $9 million IRA. They don't even really need this money to live off of. It is a tax time bomb for their beneficiaries. The only way it's not a tax time bomb is if they're going to leave it all to charity, which they're not. And so we need to think about how to diffuse that time bomb, particularly now that it looks like we might see a lot of the sunsetting provisions of the Tax Cuts and Jobs Act be extended, with President Trump being elected and Republicans controlling Congress, which is a different meeting for a different day on strategy. But if you look at the far right-hand side, the tax advantaged is like the opposite. That's Roth plans. That's your HSA in retirement. An HSA in retirement is an incredibly valuable later bucket asset, because even if through your whole retirement you save your receipts, there's some really strategic, it's kind of morbid, but deathbed planning you can do to extract all that compounding tax-free money out before you pass away and reimburse yourself for all the previous years. And then the most powerful estate planning tool that exists is cash value life insurance, permanent life insurance. It's the only financial vehicle that can be structured to be both income tax free and estate tax free if done properly. Yeah. So when we look at kind of the two guardrails, it's pre-tax where you're defer. It's somebody else's problem, maybe even your own later on when you make it to required minimum distributions, or tax advantage where you're ripping the Band-Aid off and eliminating the government from part of your plan. Now, of course, there's limitations to how much you can do in either of these, because the government doesn't want billionaires piling all their money into either one of these. And so the middle funnel is our post-tax. These is typically investments that are made with after-tax dollars, brokerage accounts, bank accounts, trust accounts, real estate, and there's some tax benefits. Typically, the growth of this money is going to be preferentially taxed if you hold it for at least a year, or you can structure qualified dividends. I mean, Conrad, we were just reviewing a client we're meeting with later tonight. They're worth over $30 million. About $20 million is real estate. But one thing you pointed out on their tax return is they had a huge amount of dividend income, but only about half of it was qualified dividends, right? And so even thinking about the right investments to hold in the right accounts could make a big difference on your tax return.
Absolutely. Yeah. And in that specific case, about 45% of their dividends were qualified. And so it leaves a large amount subject to regular tax rates. And at their income level, they're paying 37%, which is the highest marginal federal tax rate plus dividends are subject to the net investment tax of that. So they're paying 41% where they could be paying 19.
Yep, exactly. And now I know I'm also throwing out some big numbers, $20 million client, $30
Sure.
million client, right? That doesn't mean you have to have that much to work with us at Alison Wealth Management. We've got a team of advisors. We work with clients that have at least $500,000. Most of our retirement clients are at least 2.5 million of investable assets. And of course, we've got the capabilities to help engineer and design some very unique multi-generational wealth plans for our clients that do have 20, 50, $100 million of assets as well. So don't get intimidated at the numbers. We have a team of professionals that can help you no matter where you're at. But there's so many opportunities in the tax code, right? If you think about taxes like a measuring cup, this is how the tax code works. We have a high standard deduction today, $29,200. If you're over 65, you get a little bump up, and that's the amount of money you could have completely tax-free each and every year. That's an important planning number for a retiree. Then from there, the money starts to flow into this measuring cup. The next 23,000 for a married person or 11,600 is taxed at the 10% rate. Then up to 94,300 for a married person or 47,000 for a single is taxed at the 12% rate. But if you just look at those numbers alone, this is what Conrad was talking about earlier. If you are married in retirement and then you lose your spouse, you go from the right-hand side to the left-hand side. For the same amount of income, you're going to pay exponentially more in income tax, and you need to have a plan in place for that.
Right.
In addition to that, one of the most overlooked opportunities that retirees miss is what we call bracket bumping or bracket topping, meaning that let's say you have $75,000 of taxable income that you're using to support your lifestyle in a given year and you're married. Well, you can see you could actually have up to 94,300 before you get out of that 12% bracket. That's almost a no-brainer to go ahead and pay the tax at 12% because that allows you to get that money to a status that is completely tax-free forever. Same thing at that 24% bracket. We see a lot of our high-income retirees where we're filling up the top of that bracket. I just met with another client earlier this morning where we're discussing going to the 32 or 35% bracket because their two adult children who are going to be the full beneficiaries are very successful. They're in the highest brackets, and they're also in a state that has a state income tax where mom and dad are in a state that does not have a state income tax right now. So there's a lot of strategic decisions of how and when to rip off the Band-Aid. But when it comes to tax strategies for retirees, these are some of the go-tos that we're doing year in and year out throughout the year for our clients. Tax optimized income distribution, looking at how much you should take out of your pre-tax money, your post-tax money, your tax advantaged money, so that you could maximize your income and minimize your taxes, particularly around Social Security optimization and provisional income tax. The second, bracket bumping Roth conversions. The third, market timing Roth conversions, right? Conrad, about a year ago, we were speaking with a client who had a bunch of NVIDIA in their 401 or in their IRA, actually. Right. And they were very bullish on the outlook of NVIDIA. Well, if you're very bullish on the outlook of NVIDIA, where would you rather hold it, in your IRA or your Roth IRA?
Roth IRA.
Right?
I want all that growth tax-free.
Exactly. And by doing the conversion and paying tax on it, we got all that growth to be tax-free. Of course, we know the rest of the story. NVIDIA has gone up exponentially in value since that happened. And that's a huge tax-free windfall. So that's an example of a market timing Roth conversion. In down markets, there's huge opportunities. Like in 2022, we were doing this, calling all of our clients saying, hey, we know the market's down, but let's start thinking about how we can eliminate Uncle Sam from the recovery.
Right.
We also look at qualified charitable distributions or donor advised funds for our clients that are charitably inclined. If they have substantial after-tax money, we've got some very unique tax loss harvesting strategies. And then, of course, annual intra-family gifting are all strategies for our clients. And we built a process called the tax management journey that we walk our clients through to help ensure that we're taking advantage of all of these opportunities, whether it's how the assets are invested and how we're managing them, to gifting strategies, to Roth conversion strategies. But when we talk about optimizing retirement, step one is build your bucket plan. Step two is optimize for taxes. And then step three is select and implement the right investments. And so when we look at investments, we use this idea of the pyramid of risk. At the top of the pyramid are things we would deem high-risk investments. And high-risk investments have the opportunity for high returns, but they also have the opportunity to do what, Conrad?
Go to zero.
Right? Go to zero, right? So up here, we have alternatives like cryptocurrency, oil and gas speculation and drilling, private placements and investments, private market investments. We also have highly concentrated individual stocks and bonds. I'm not talking about a diversified portfolio of individual stocks. I'm talking about highly concentrated. Now, in the middle part of the pyramid, we have diversified investments. We have stock funds, bond funds, ETFs, index funds. These give us access to a very diversified universe within a single fund. We also have variable life insurance. Again, could be a good solution for ultra high net worth to be able to defer and create tax-free income. We also have variable annuities or annuities in general. And so I'll just kind of talk about annuities in general because these can get a bad rap, and there's some good ones and there's some bad ones, just like any other investment. But there's really three types of annuities. There's a variable annuity, which is issued by an insurance company. You get tax deferral, very similar to an IRA. You're going to be invested in the stock market. So inside of the annuity, you buy things like stock funds, bond funds, ETFs, and index funds. You can access a certain amount of your money each and every year without penalties. And you can purchase for a fee additional benefits, such as the ability to have a lifetime income payout, essentially like a pension you can't outlive, a death benefit if you're uninsurable, long-term care benefits if you're worried about the cost of care. These are all ancillary benefits, but they have fees and expenses. And so one of the raps that variable annuities get is that they're filled with high cost, and they absolutely could be. I've seen some horrific variable annuities with 3, 4, 5% a year in fees, but it's because the investor truly didn't know what they were purchasing. They probably didn't work with a fiduciary who has a legal obligation to do what's in their best interest, which of course we are at Alison Wealth. The other type of annuity is a fixed annuity. This is basically like a bank CD. You turn your money over to the insurance company and they give you a fixed interest rate for a fixed period of time. For example, 5% for 5 years, but you as the investor have the opportunity to defer the interest each year, or you can access that interest as a withdrawal to help supplement your retirement. And then the third type of an annuity is an indexed annuity. Again, tax deferral. Your interest rate is going to be indexed to market indexes like the S&P 500. So if in a given year the S&P 500 goes up, you're going to earn a favorable interest rate. You might get 30, 40, 50, 60% of what the S&P 500 does. You're going to lock in that gain each year. And if the market goes down, you simply earn a zero that year. So it's really just creating a hedge. You know what your downside risk is, zero. And then you typically have an upside participation rate, but you're not going to get the full upside of the stock market, right? There's no free lunch out there where you get none of the risk, but all the return. Although there's some promoters out there that like to try to pitch it that way, isn't there, Conrad?
Oh, absolutely. We've heard it all too.
Exactly. So again, you can access penalty-free withdrawals, just like a normal investment account, and you could purchase additional benefits like lifetime income. So again, these are things, fixed annuities, very indexed annuities. These are at the base of the pyramid. These could be good, alternative investments in a soon bucket. Again, things in the middle and top part of the pyramid typically are, soon bucket for somebody who maybe has more of an appetite for market risk or volatility, or later bucket assets for sure. So again, the pyramid of risk also has things like government bonds in the base of the pyramid, fixed cash value life insurance like whole life or indexed universal life, and then of course cash savings, CD, money market accounts, the things that provide us the most liquidity. So in today's environment, when we're building and constructing portfolios for clients, here's the most common things we're helping them think through and navigate and implement. Of course, annuities for guaranteed income, bonds and fixed income, and we're really managing the duration and the interest rates of those bonds and fixed income. Structured notes could be a good kind of more conservative or less volatile asset. Defined outcome ETFs we're using immensely right now. These are publicly traded ETFs where we can dial in the amount of volatility you're comfortable with. So we can use buffer products like on the S&P 500 that, will basically give you a buffer of up to, let's say, 20, 30, 40% losses in the S&P, but still allow you to participate in pretty high upsides, all the way to very low volatility strategies where we can basically have pretty much no downside in the S&P, and again, still a pretty competitive upside potential and interest rate. We also are using active risk management portfolios. We're looking at multi-asset income portfolios for income generation. This could be like munis, preferred stock portfolios. Private credit is a very attractive alternative asset we're using for clients to get a pretty high income stream. And then covered call income portfolios, again, a more sophisticated strategy we're using, whether we're building a diverse portfolio off of indexes, or maybe you have a highly appreciated position and you don't want to sell it and pay the tax on it, but you want to start generating some spendable cash flow. And we're seeing a lot of that with, some of our clients that have like Meta or Nvidia or some of these other companies that have had just huge run-ups in value over the last 3, 4, 5 years.
Yeah.
So let's talk about how all of this comes together. We're a partner firm of Prosperity Capital Advisors. I'm actually one of the founders of Prosperity Capital Advisors. I co-chair the investment committee. We manage over $4 billion of client assets today. We were recognized by Financial Advisor magazine as one of the 50 fastest growing RIAs. We were ranked by USA Today as one of the best financial advisory firms in America. We have an incredibly big, diverse team of subject matter experts and can tap into institutional capabilities. We partner at Prosperity Capital and Alison Wealth Management with Charles Schwab and Fidelity. They're the places that hold our clients' money. We are then just investment advisors. We are fiduciaries, which means we have the highest legal duty to you as the client. We have to represent and act in your best interest at all times legally. This is incredibly important if you're looking at anybody to get financial, tax, or retirement planning advice from. And then in addition, some of our advanced designations, both Conrad and I are certified financial planners and bucket plan certified. Conrad is a CPA. Myself and our other team member, David, who is our client service advisor, are both enrolled agents. So again, we're focused on continued education. We've had a number of accolades and appearances. I've been named Think Advisor Luminaries 2023 winner for thought leadership in the financial space. Investment News 40 Under 40, wealthmanagement.com Thought Leader of the Year for RIAs. We've been named a 5-star wealth manager and are frequent contributors to US News, Forbes, Bloomberg, Market Watch. So, all this to say, we are totally invested in continuing our own education to bring the best ideas and recommendations that we can that help our clients achieve their goals and objectives. And so what our offer is to anybody who made it through this webinar, we'll do a complimentary consultation. We're going to learn about you, you learn about us, we'll get your questions answered. And so to sign up, as I mentioned before, I put an offer here. You can just click on that, or you can go to AlisonWealth.com. That's Alison, ALISON, Wealth, WEALTH.com/Conrad. And Conrad, when they go to this website, what happens?
Yeah, so they'll see kind of and you can see on the screen, they'll see about midway through on the right side a blue button that says Book Now. You'll click on that, Book Now, and you'll be diverted to a screen that shows calendar time availability for myself. Find a day and time that works well for you. Notice there's a 45-minute introductory session. We want to make sure we have ample time to answer your questions, along with scheduling that meeting. If you haven't already, we'll be glad to send you a copy of the bucket plan. It's a great read. And then ultimately what we'll do in our meeting is talk about the bucket plan and find out how it helps you.
Awesome. Well, we appreciate everybody jumping on today. Again, I think there's a lot we can do to help bring value to your situation. Give us a chance. Let's schedule that next step to have a conversation. Go to our website, AlisonWealth.com. And I thank you for participating. If you have any additional questions, please feel free to put them in the chat or email us, and we'll make sure to get them addressed and get you the information that you need. Thanks, Conrad.
Thanks, Dave. As Dave mentioned, we've got a couple more minutes here. If you have any other questions, go ahead and put them in the chat. We'd be glad to answer anything we can. I know time is short, and you guys have been great participants thus far. We appreciate your time, and please let us know if we can do anything else for you here today.